Alrighty guys, good afternoon. Welcome to the mentor session. Something I wanted to cover was, it was a discussion we've been having recently on the career course anyway, around correlation and how to view correlation and some of the mistakes people can make and how to kind of look at correlation to avoid the risk of assuming that a correlation is broken down when it hasn't, or also assuming there's a correlation there when there isn't. So, we'll get nice and quick on this one. Let's just move us forward. Right. What we're looking at then, I'll just see if I can get that going. Right, what we're going to look at then is the difference between general on the day and specific correlation. Now, general correlation is all about understanding whether two markets have a relationship. Now, there are generalized rules that I think many people probably understand. I'm not going to go through all of those. But what you've got to be looking at is you've got to look at what's happened recently in a general sense and say, okay, well, what's true of this direction? I'll use the example today of oil against the S&P. Now, if you go from the beginning of the year, the general correlation is inverse. The oil goes up, S&P goes down, and that's a pretty solid relationship you can see there. Now, you have to also ask yourself, is this coincidental or is this actually a correlation based on reasoning? i.e., if the reason for this seeming inverse correlation changes, will you also get the inverse back as well? That's what really kind of clarifies whether you're genuinely seeing correlation or whether it's a coincident situation. You need an element of cause. I've got an example here of McDonald's restaurants and inflation. And the question around do McDonald's restaurants cause inflation? Just because there are more McDonald's restaurants now than there were and inflation is higher now than it was, does not necessarily mean that one causes the other. One would assume that as prices start to rise, as people have more money, McDonald's is going to open more restaurants as their business grows. This doesn't promote inflation because for inflation, people need to pay higher prices for things. Just because McDonald's is supplying more stuff, arguably this could be disinflationary. So there isn't a link. What we're looking at then with the S&P oil inverse correlation, is there a fundamental reason for it? Yes, absolutely. I don't think you need me to go into that precisely. The Ukraine story. Oil goes up, S&P goes down. Quite a simple risk on, risk off relationship. Commodities don't have a consistent risk on, risk off relationship with stocks in the same way that bonds do. So that's something important to recognize. So we can all understand the general correlation and we can all understand the truism of directional movement and part of the reasoning why. You also then need to look at the on-the-day correlation. I think this is where people make the mistake. They make mistakes of thinking that correlation is broken down. They make the mistake of overweighting a correlation just on one day. Whereas if you know that the general correlation is inverse, then you can look at a movement on a day and say to yourself, okay, based on this, we could just be seeing a kind of a shift in the current movement. And this can also relate to the situation. We'll go and look at Monday in a little bit, which seemingly, dependent upon when you looked at it and where you focused, absolutely the correlation broke down. But in reality, this is probably not the case. Both oil and the S&P did go down on Monday, but for very, very different reasons. And this is where specifics matter. It's all well and good to understand correlation generally, but the specifics count. And this goes a little bit like last week where I was talking about the details matter. You can't trade off generalized ideas. You need to be specific. So where the fundamental reasoning comes into play, where you get news that relates to this fundamental reasoning, that's when the correlation you should expect to work exactly as you have seen it do, which it does. This is what matters. So then it's about the turning points. It's about what happens at specific moments when some news comes in. That's where your opportunity is. So we're going to have a quick look generally. This is your general inverse correlation. Oil has gone straight up. This is from the beginning of the year. Oil has gone up from about 72 up to around 125 at the time that I put this chart up. Oil currently is around about the same price, but who knows where it will be at later dates. S&P, likewise, has come off. S&P's dropped around about, around about 600 handles. So there is a pretty clear inverse relationship. So the general relationship holds, and you can understand why this is as well. To start with, oil rising promotes inflation, which is bad for the S&P. Then you add to it the Russia-Ukraine situation, ramps oil up. It's a risk-off play and an inflation play, inverse correlation. It makes sense. So the correlation is absolutely there. Where people make the mistake is on the day. Because on Monday, oil went down and the S&P went down. But I think what people often do here, and where the mistake comes, they go, okay, so these should go inverse. S&P drops, oil doesn't go up. The correlation is broken down. They jump very quickly to this conclusion that the correlation is broken down, where in reality, you're in a different situation. S&P is sitting in a range and trades out of a range, so the red arrow being the open to the close of the day, full session. S&P's in a range and trades out of a range. Oil gaps up 6 points, rallies 9 points, and then closes basically where it opened. So it's hard to say that oil's really gone down. Where the mistake comes is people often look at this, the red box, which is approximately the same period in each, and go, oh, well, oil dropped and S&P dropped. And really what they're saying is, I noticed this move and oil also went down. So the correlation is broken down. Whereas that's sort of taking your general view and then generalizing it onto the movements within a day. What you need to be caring about is the specifics of what happens here. Because yes, oil does go down, but if you look at that box, oil goes down, S&P goes down, goes up, goes down. So actually, the inverse correlation does hold to a degree. Oil goes down, the S&P doesn't go down as such. It has a messy run around to go sideways. Very, very different situation. And so what you need to be looking at is the specifics. When does this correlation matter? Because you're not trying to trade a correlation on every last little bit of movement. You're trying to trade it when it matters. When this is going to matter is when you have a fundamental story regarding that relationship. Germany suggesting that it will not impose sanctions and stop buying Russian oil. What happens? S&P goes up, oil goes down. Of course, because if Germany is not going to stop buying Russian oil, then Russia can still keep selling its oil, supply of oil effectively increases, price drops. So we get this drop in price. So if you look at where the highlight is, the inverse correlation absolutely works there, and down to the red arrow, which is the same price, the turning point comes at exactly the same time. That's where the correlation helps, when you have a specific situation where you would expect this correlation to play out. So it then is not based on the general technical landscape, which allowed for oil to drop, which allowed for the S&P to drop. So the correlation seemingly breaks down. And it's not so much that it breaks down, it's just where they are situationally allows for this perceived breakdown of correlation rather than reality breakdown of correlation. But when it matters, it holds absolutely. So one can assume that the correlation is very much still in play and that we can follow that onwards for the rest of the day and week until we start to see some change. What's going to help you understand that change in correlation is going to be a situation where you'd expect them to do something opposite to each other and they don't. That's how you know that the correlation is starting to change. So something to watch out for in the coming days. I'll wrap it up there, guys. Have a good rest of your day. I'll see you all later on. We'll do ECB rundown as to what the ECB can do tomorrow. Catch you all then.